Silver looks calm right now. Almost boring. It's sitting around $82 an ounce in Western spot markets, not exploding higher, not collapsing lower, just hovering there as if it has found some comfortable middle ground. From the recent low near 63.90, it rallied roughly 30% to about 93. Then from that 93 peak it corrected back down close to 82, again roughly 30%. Perfect symmetry. Perfect balance. Bulls feel validated because the bottom held. Bears feel validated because the top rejected. On the surface, it looks like equilibrium. But markets have a habit of looking the most stable right before they break. Before we go deeper, if you appreciate analysis that connects numbers most people ignore, then take a second to subscribe. It genuinely takes a lot of work to dig through inventory reports, open interest data, and global supply numbers to build something meaningful like this. Subscribing helps the channel continue bringing you strategic warnings instead of surface-level noise. Now let's continue. At $82, silver feels neutral. Not cheap enough to trigger panic buying. Not expensive enough to trigger widespread fear. Technical traders look at resistance near 85, they watch moving averages, they talk about failed breakouts. Momentum indicators show neither extreme greed nor extreme fear. Volatility has compressed. Daily ranges have narrowed. To a casual observer, this is a healthy, balanced market. But balance in price does not always mean balance in structure. There is a difference between true equilibrium and what professionals sometimes call an equilibrium trap. True equilibrium is when supply and demand genuinely meet at a sustainable level. Participants on both sides feel satisfied. Inventory flows smoothly. Delivery obligations are easily met. Confidence is intact. An equilibrium trap looks identical on the chart. The price stabilizes. Volatility compresses. Traders grow comfortable. But underneath, the foundation begins to crack. Silver right now is showing signs of that second condition. Let's look at the numbers that most traders never bother to connect. COMEX registered silver inventory recently fell to 98 million ounces. That might not sound dramatic at first, but it is the first time in the modern era of commodity tracking that registered inventory has dropped below 100 million ounces. That threshold mattered because for years, even decades, registered inventories typically hovered well above 150 million ounces, sometimes above 200 million. There was cushion. There was buffer. There was room. And then, in a single February trading session, 5 million ounces were withdrawn from COMEX registered vaults. Not reclassified. Not shifted to eligible. Withdrawn for delivery. Gone. And that single move pushed inventory below 100 million ounces. To understand why that matters, you have to understand how the COMEX warehouse system works. There are two main categories of silver stored in approved vaults, eligible and registered. Eligible silver belongs to private owners who store metal in COMEX-approved facilities but have no obligation to deliver it against futures contracts. Registered silver is different. Registered silver is specifically available to meet delivery demands from futures contracts. It is the metal that backs the paper promises. Right now, registered silver stands at 98 million ounces. Against that physical backing sits approximately 65,000 March futures contracts. Each contract represents 5,000 ounces. That means 65,000 contracts equal 325 million ounces of silver. So you have 325 million ounces of paper claims potentially standing for delivery, backed by 98 million ounces of registered physical metal. That is a ratio of 3.3 to 1. More than 3 ounces of paper claims for every ounce available for delivery. Defenders of the system will immediately say that most contracts never go to delivery. They settle in cash. Traders roll forward. Speculators close out positions. That is true. Historically, Only about 2 to 5% of open interest actually demands physical delivery. Even in tight markets, it rarely exceeds 10%. But the system depends entirely on confidence that registered inventory is sufficient to handle whatever percentage does stand for delivery. Now consider the timing. February 27th is first notice day for March contracts. That is the date when contract holders must declare their intention, cash settlement or physical delivery. 14 days is not a long time in commodity markets. If even 15% of the 65,000 contracts demanded delivery, that would be 9,750 contracts. Multiply by 5,000 ounces per contract, and you get 48.75 million ounces. Nearly half of total registered inventory for a single month's deliveries. And March is not the end. April, May, July contracts are already building open interest behind it. The arithmetic becomes uncomfortable very quickly. This is not speculation about some distant crisis. These are publicly available numbers. 325 million ounces claimed. 98 million ounces registered. 3.3 to 1 ratio. 14 days to first notice. What makes this even more interesting is that the 5 million ounce withdrawal that broke the 100 million threshold did not occur during a price spike. It did not happen in a panic. It happened while silver was sitting calmly around $82. That means someone looked at this equilibrium price and decided physical possession mattered more than paper exposure. They withdrew metal while volatility was low and headlines were quiet. At the same time, the global structural picture is tightening. The Silver Institute projects a 67 million ounce deficit for the current year. On its own, 67 million ounces does not sound catastrophic. Global mine production is roughly 800 million ounces annually. So 67 million is less than 10% of yearly production. But this is not year 1 of deficit. It is year 6. 6 consecutive years of supply failing to meet demand means cumulative deficits approaching 400 million ounces over that period. That 400 million ounces did not vanish into thin air. It came out of above-ground inventories. Vaults, ETFs, private storage, stockpiles built during previous surplus years. Those buffers are not infinite. Visible global above-ground inventories are estimated around 2 billion ounces. That sounds large until you realize annual demand now exceeds 1.2 billion ounces. At that pace, even without growth, visible inventories represent less than 2 years of global demand. And demand is not shrinking. Unlike investment demand, industrial demand does not disappear easily during downturns. These are structural requirements of modern technology. On the supply side, most silver is produced as a byproduct of copper, lead, and zinc mining. Primary silver mines represent a smaller fraction. That means production cannot quickly ramp up just because price rises. The supply curve is relatively inelastic. Meanwhile, Eastern markets are sending a different signal than Western paper markets. In Shanghai, spot silver has been trading around $88, and Shanghai futures near $90, representing a $6 to $8 premium over Western prices. That premium has persisted for weeks. When physical metal in one region consistently trades at a premium to paper contracts in another region, it indicates strong local demand for actual delivery. Physical buyers in places like Shanghai and Mumbai are not staring at hourly moving averages. They are looking at structural deficits, at inventory drawdowns, at long-term value. They remember silver below $20, below $30, below $50. To them, $82 in the context of 6 years of deficit may not look expensive. This divergence creates tension. Paper traders see resistance at 85. They see failed breakout attempts. They see weakening momentum. They anticipate possible moves back towards 75 or even 70. And technically, that scenario is not impossible. Charts do show hesitation near resistance levels. But now consider asymmetry. If silver drops 30% from 82, it lands near 57. At $57, with a structural deficit and shrinking inventories, industrial users would likely accelerate purchases. Solar manufacturers would lock in supply. Electronics producers would build inventory. Investment demand would likely surge at what many would view as undervalued levels. A sharp decline could quickly reverse as physical demand absorbs supply. Now imagine silver rises 30% from 82, moving toward 106. At that level, with 98 million ounces registered and 3.3 paper claims per ounce, delivery pressure could intensify. Shorts might be forced to cover. Premiums between East and West could widen further. A rally in a structurally tight environment can feed on itself because the system was not built for widespread physical demand. This is the essence of the equilibrium trap. Downside appears limited by industrial floor demand and cumulative deficits. Upside appears unconstrained because of structural supply tightness and leverage in paper markets. The first move may not matter as much as what follows it. Timing compounds the tension. February 27th, First Notice Day. Spring industrial restocking. Solar installation season. Electronics production cycles. Currency volatility. Policy decisions affecting inflation expectations. These variables are converging within weeks, not years. For industrial users, this is not theoretical. Procurement departments should model scenarios where silver prices rise 20 to 40% within a quarter. Not as a guaranteed outcome, but as a realistic risk case. If physical premiums widen, the effective procurement cost may exceed quoted spot prices. For investors and portfolio managers, silver presents an asymmetric profile. The downside may be cushioned by structural demand. The upside, if inventory stress translates into price discovery, could be nonlinear rather than gradual. Inventory already dropped below 100 million ounces. The 3.3 to 1 ratio already exists. The 6-year deficit is already recorded. First Notice Day is already approaching. The only uncertainty is timing and direction of the initial spark. The structural conditions are already in place. Whether participants recognize it before or after the adjustment determines whether they act at equilibrium prices or at break prices. In markets, by the time everyone sees the fracture, the repricing is usually well underway.